right, let's get started. Good afternoon and welcome to another webcast from FACTS Institute for County Government. The Institute is the training and education arm of the association. Anyone who is participating either today live or watching this sometime in the future on our online learning platform, anyone who's in the Certified Commissioner program can earn 1.5 elective credits for that. So today's webinar is entitled Fema's National Flood Insurance Program Risk Rating 2.0. For some local governments, the National Flood Insurance Program can be confusing because it has more than one goal and objective. Of course, it's designed to provide access to flood insurance. There's floodplain management, and then there's flood hazard mapping. And generally what I've seen in the past is communities have kind of focused on the mapping issue, and there's always been some contention there with the accuracy of maps. And then of course the flood insurance rates that we've seen kind of change over the years. Now FEMA has spent a significant amount of time and money on an investment in flood mapping. And more recently, they have spent its efforts in really trying to evaluate the risk of flood on individual properties. So while in the past it's always been focusing on the community-wide maps, the effort now is on really trying to get engaged an accurate risk rating on individual properties. So this is called Risk Rating 2.0. It was actually delayed under the previous administration, but it is being implemented in phases. Phase 1 actually began October 1st. So anyone that is getting a new insurance policy, the Risk Rating 2.0 process applies to them. And then in the spring, beginning April 1, anyone with an existing flood insurance policy, Risk Rating 2.0 will apply to them. So I think if you look around, there's most of the major newspapers in the state of Florida have written about this in some aspect, but it's typically on a very narrow angle about how many policies are going to be under the NFIP and how many are being dropped out and whether or not their flood insurance rates are going to go up and down. But they haven't gotten into this whole idea of what does Risk Rating 2.0 really mean to ensure that communities can reduce flood losses. And so with that, I'm really pleased to introduce Chris Perez with FEMA Region 4 in Atlanta. Region 4 covers the state of Florida. Mr. Perez is a floodplain management specialist, but he's actually been with FEMA for several years. He actually had experience and background in the public assistance program and has been in the flood insurance program for a better part of 4 to 5 years. So with that, I want to welcome you, Chris, for coming and presenting today. I'm going to minimize my screen, and then anyone who's participating that has questions, please put them in the chat or in the Q&A, and then we'll get to those towards the end. So Chris, welcome. Thank you.
Thank you for the introduction and great opening comments there. Very accurate and timely. So yeah, thank you for having me. Good afternoon. Like Eric said, my name is Chris Perez. I'm one of 2 regional flood insurance liaisons here in FEMA Region 4, based out of Atlanta, Georgia. A little bit about myself. I've been with FEMA for a little over 17 years. Started in the recovery division, but working both IA, individual assistance, and public assistance. Did that for around 13 years. Deployed to over 70, 80 disasters throughout that time, kind of lost count. And then most recently, I started in 2017 in floodplain management, also in Region 4. So I was a floodplain manager assisting the state of Florida. Actually, Florida was one of my assigned states. I had Florida and Alabama. So I worked very closely with FDEM, the federal Florida Department of Emergency Management. Some of you may know Con Cole, the state NFIP coordinator. And then most recently, just March 1st of this year, I took this new role of the management and program analyst for the branch and also the second regional flood insurance liaison. So we also have Dewana Davis on the line. She's our other regional flood insurance liaison. And so plenty of experience with FEMA. And I've had some time working with the legacy NFIP insurance rating systems for a little bit over the past 2 years. So I know that, old habits are hard to change. And for those of you who have worked with the NFIP for many years, the current or the past rating methodology is very familiar. But I think that you'll find that the new pricing methodology it's not just a minor improvement over the old methodology, but it's a transformational leap forward. It enables FEMA to set rates that are fairer and also ensures that rate increases and decreases are both equitable. That's one of the main priorities of our current administration, is to make sure that we're equitable. So this is one way we're doing that. So FEMA is building on years of investment in flood hazard information by incorporating some private sector data sets, some catastrophe models, commercially available catastrophe models, and also evolving actuarial science in order to implement Risk Rating 2.0. So with Risk Rating 2.0, FEMA now has the capability and tools to address rating disparities by incorporating more flood risk variables and a broader range of data sets. And so these include more flood frequencies, not just the 1% flood that we're used to dealing with, and then also a greater range of flood types and individualized property characteristics, such as distance to flood source and the cost to rebuild. And we'll get into some of that as we move through some of these slides. So now that you've seen my face, just to save some bandwidth, I'm going to go off camera as we continue through the presentation. And then towards the end, we'll have a question and answer session, and I'll come right back. Okay, so in Risk Rating 2.0, there's a lot of complexity that's being calculated and automated in the background. Now, many of the Risk Rating 2.0 variables are automatically derived from a geolocated property address. So you and I, we won't know everything that's happening in the background, as much of the rating process will now be automated. The ability to manually determine a rate by looking up a rate table, that's going away, since the new risk rating engine will calculate an individualized premium for every policy. So you can get comfortable with Risk Rating 2.0 conceptually to generally describe the variables that have a greater impact on premiums. Here at FEMA, we hope that this training will help you better understand the benefits of and the rationale behind Risk Rating 2.0, helping you to explain the benefits of the new rating system and also alleviate some fears among stakeholders and dispel some of the myths and misinformation about Risk Rating 2.0. Now, FEMA is working towards leaving as much of the complexity as possible to the computers so that the FEMA team members and partners can focus their time and energy instead on helping policyholders understand their risk and enabling them to take appropriate action to mitigate against it. So by simplifying the flood insurance selling and purchasing process, insurance agents will be better positioned to help a policyholder understand the impact of specific mitigation actions on their premium during the quoting process. And lastly, it's important to understand that Risk Rating 2.0 is part of a larger effort to transform the NFIP, otherwise known as the NFIP transformation, which will eventually include changes to the community rating system, floodplain management, and the flood risk data and mapping programs. And those are some of the components that Mr. Poole mentioned early on in his introduction. Achieving these significant transformations require continuous improvement at the organizational level, beginning with the insurance rating methodology. So before we dive into some of the details of Risk Rating 2.0, let's review where the NFIP is currently. And I should have updated this slide, but as of April 1st, 2021, the NFIP has roughly 5 million policies in force, and that's composed of 95% residential policies and 5% non-residential policies, with over $1.3 trillion of coverage. As of April 2021, we have 22,525 communities which participate in the NFIP. I'll back up a minute there. The NFIP is a voluntary program. It's a quid pro quo program. So communities have to opt in or volunteer to join the NFIP. And with that comes the floodplain management regulations that come along with it. So with that context in mind, let's dive into some of the details of Risk Rating 2.0. Let's talk about the why of Risk Rating 2.0. And we'll start by revisiting the motivation behind our landmark efforts. It's the why behind all the hard work and commitment. This new approach allows us to set actuarial sound rates and identify flood risk more comprehensively than ever before. This change will also address an inequity in the program that is built up over time and must be corrected. Specifically, policyholders with lower value homes may have been paying more than they should, and policyholders with higher value homes could be paying less than they should. The new pricing plan enables FEMA to set rates that are fairer and ensures both rate increases and decreases are equitable. We've learned, for example, that 2/3 of older pre-firm homes, which have some of the highest rates in the NFIP today, will actually see a decrease in their cost of insurance. Our new rating methodology has revealed these inequities, and as a federally mandated program following Congress's direction, we cannot turn a blind eye to policyholders who have been unjustly subsidizing other properties. So while change is difficult, we really believe now is the time. As Mr. Poole mentioned earlier, this was delayed by the previous administration, but we think this is the right time, and so we've started to implement it. So within the current system of rating buildings, or the legacy system, which we will occasionally refer to as risk rating 1.0 or the legacy rating system, flood hazard is essentially viewed through the lens of being either in or out of a given flood zone. So FEMA generally treats the hazard facing different buildings within the same flood zone as similar. And the legacy system includes only two types of flood hazard, and that's the 1% annual chance fluvial or riverine flood and the 1% annual chance coastal storm surge flood. There are significant swaths of the country that are not subject to the 1% annual chance of flood, according to flood insurance rate maps or firms. So this means that a sizable number of policyholders pay similar premiums, even though they are located in different parts of the country and face many different types and levels of flood risk. Risk rating 2.0, as one of the key efforts of transforming the NFIP for the better, seeks to better differentiate flood risk for each NFIP insured building, including those outside of the special flood hazard area. FEMA's view of flood risk is moving from a deterministic or binary view to a more graduated view of risk. This view is moving away from needing to know if a building is in or out of a flood zone to a more individualized review under risk rating 2.0. This means individual buildings can be assigned specific annualized probabilities of being impacted by flood. And the benefit of a more graduated risk view of risk is that we can avoid a situation that happens today where a building could be located just outside of the 1% annual chance floodplain as depicted on a flood map, but it may still face significant flood risks that have not been accounted for in its current rate. So we all know that floods don't stop at a line on a map. And so FEMA is moving towards integrating that graduated risk view of risk across the NFIP, including those various efforts for the future of flooding risk data, or our mapping program, also floodplain management and the community rating system, also known as CRS. And risk rating 2.0 is just a first step towards recognizing that the simple zone distinctions, while they have their purpose, are overly general when it comes to insurance rating. Under the legacy system or risk rating 1.0, once you go over a line, a rate can be very different. But under risk rating 2.0, adjustments to the inputs and variables that go into calculating a rate may make a marginal difference to the rate. Risk rating 2.0 keeps the rating methodology from overweighting any one variable in a way that causes minor changes to have an outsized impact on the final rate. To implement all of these new rating variables, FEMA actuarially blends different models, such as those traditional NFIP mapping data or flood insurance rate maps, as we discussed before, and commercial catastrophe models. And by using and blending different models, FEMA can develop a more accurate and nuanced rating plan that more accurately reflects the risk of flood damage to an individual building. And so we believe risk rating 2.0 is necessary because we all know that water doesn't stop at a flood line drawn on a map. Communicating flood risk to the public through insurance rates tied to a binary line, well, it's just not sufficient anymore. The 1% annual chance line does not describe the complete range of all of the flooding that could possibly happen to a building or structure. But through Risk Rating 2.0, FEMA can set actuarially sound rates and communicate flood risk more comprehensively than ever before, enabling us to fulfill our obligation to clearly communicate flood risk. And risk is exactly what flood insurance pricing should be based on. By providing policyholders a clear and concise picture of their unique flood risk, which has never been done before, we are equipping them with the information necessary to make more informed decisions, including mitigation actions they can take to reduce their risk. We believe mitigation coupled with insurance equips individuals with the essential tools they need to recover after disaster strikes. As some of you may have heard, the entire NFIP program has also been on unsound financial footing for quite some time. Since 2005, the NFIP has paid out over $35 billion more in claims than it has collected in premiums. And it currently has a $20.5 billion debt. There are also people in this country who don't know they're at risk and don't have insurance, even though they should. To build a more prepared and resilient nation, the NFIP has to change. And underlying that change is updating FEMA's risk rating structure and methodology. And remember, our rating methodology hasn't been updated in more than 40 years. It is not fiscally sustainable in its present form to withstand the frequency and intensity of recent events and the storms we know will strike in the months and years ahead due to climate change. And I think you all in Florida can attest to that with the amount of storms you guys get. This year, thank goodness, was not as busy as it normally is. Risk Rating 2.0 will also help put the NFIP on a financially sound path toward a more resilient program that is more accountable to taxpayers, more accurately communicates flood risk to policyholders, non-policyholders, and communities, and helps disaster survivors recover after floods. Now, let's look at just what is changing in the rating methodology. And we'll focus on the bigger picture and the bigger implications of this shift to the new rating methodology. You notice immediately, if you look at the slide, the greater and more diverse range of rating variables that are taken into consideration to calculate a premium, which is in contrast to the legacy pricing methodology on the left-hand side of the slide. Within the legacy pricing methodology, flood risk is largely viewed through just a few key variables, including flood zone and the elevation difference between the lowest floor and base flood elevation. The legacy pricing methodology approach also includes only two types of flood hazards I mentioned previously, the 1% annual chance fluvial or riverine flood and the 1% annual chance coastal storm surge flood. Through the new pricing methodology, FEMA now has the data and information technology to more accurately assess flood risk and price insurance to better reflect that risk. Let's also discuss what this shift means to FEMA team members and our partners. An important mindset we must adopt as we transition to Risk Rating 2.0 is to fully appreciate that FEMA is moving away from determining the flood insurance premium using flood zones and base flood elevations. So asking questions like, how would a V zone or an A zone look under Risk Rating 2.0, or to what BFE level should machinery and equipment be elevated above? Well, those are not particularly meaningful questions on the Risk Rating 2.0. And that's because risk and rating are individually assessed for each building and not determined by flood zones or base flood elevations under Risk Rating 2.0. The legacy pricing methodology operates by comparing properties to a set national standard. In contrast, the goal under Risk Rating 2.0 is to better understand the specific flood risk of each NFIP insured building and of its surrounding area. Under Risk Rating 2.0, FEMA looks at flood risk from as many sources as possible in order to set insurance prices based on that risk. The goal of Risk Rating 2.0, unlike the legacy system, is not to set generalized rates based on flood zones or base flood elevations. We're setting risk-based rates according to the unique risk characteristics of every individual property. So it goes without saying that Risk Rating 2.0 brings sizable changes to the FEMA organization. And it's important to acknowledge this. And it's also important to acknowledge that Risk Rating 2.0 brings improvements to rating. This change, however, means letting go of the way we're used to assessing and rating flood risk, at least when it comes to insurance pricing. Another important aspect to appreciate about Risk Rating 2.0 is there's a lot of complexity that is being calculated and automated in the background. For example, many of the Risk Rating 2.0 variables are automatically derived from a geolocated property address. As this is going on, we will not be looking at everything that is happening in the background. And as I mentioned before, the days of determining a rate by looking up a rate table are going away. We won't be able to do this anymore, since the rating engine will be calculating an individualized rate using a lot of math, not one of my strong subjects. Now keep in mind, in Risk Rating 1.0, we don't go into the details about how we arrive at the numbers that populate each rate table. We just publish them and they are what they are. In Risk Rating 2.0, we similarly do not go into the details of every single calculation of the rating engine. But what we can do within this new rating paradigm is to develop a good understanding of the new pricing methodology to explain how it generally works. We can also develop an understanding of the variables that go into calculating a rate and the key program changes. We can also understand the variables that impact those premiums. Risk Rating 2.0 not only aligns FEMA's risk rating methodology with insurance industry best practices, but it's changing its pricing methodology in really game-changing ways. And this is truly a paradigm shift. Through the new pricing methodology, FEMA is leveraging a broader range of models and data sources, and in some cases, using data in new ways to develop rates that more accurately communicate a building's flood risk. We now have the capability and tools to address rating disparities by incorporating more flood risk variables. And we did this by incorporating private sector data sets, catastrophe models, and evolving actuarial science. We relied on cutting edge technology and the best available data to create a modern day rating system that builds and expands upon years of scientific developments, actuarial data, and environmental analysis. And catastrophe models are the backbone of this new pricing methodology. The science and data needed to model the full range of perils and magnitudes of flooding is, as an industry standard, in the early stages and continuing to advance. Risk Rating 2.0 will enable the NFIP to keep pace with those advances. So when our analysis began in 2017, a limited number of models were available that could produce averaged annualized loss, or AAL, estimates for fluvial or riverine and pluvial, heavy rainfall, and coastal flooding. While these models agreed on the general order of magnitude of flood losses for the nation, they could vary greatly by region and by location. The public and communities have been screaming for this for years, so now it's a reality. However, each available model outperformed analysis based on the current rating methodology in terms of reflecting observed variations in flood risk. As a result, a multi-model approach was adopted to determine flood risk using a suite of models. We licensed 3 sets of commercial catastrophe models, and some of you may be familiar with them. AIR, or AIR Worldwide, inland, coastal, and tsunami models. Also CAT risks, inland and coastal models, including modeling of levied areas. And then finally, CoreLogic's inland and coastal models. In addition to those commercial flood models, FEMA developed 2 additional models based on government data and models. We leverage this suite of government and commercial data sources to determine a greater range of geographical and structural characteristics of a building, such as how far the building is from a flooding source, which we weren't doing before. To design the new pricing methodology and set all the factors used to calculate an individualized rate, FEMA has drawn on many best available data sources. And those include FEMA's data sources, such as our mapping data and our Great Lakes analysis, but also our other federal government data sets, such as from the National Oceanic and Atmospheric Administration, or NOAA, the U.S. Geological Survey, or USGS, and then the U.S. Army Corps of Engineers, or USACE, to provide an extensive review of our final methodology, including our understanding and analysis of levees. And finally, commercially available third-party data sets, including the catastrophic models that I already discussed, a geolocation tool. We've also created a first floor height tool and the replacement cost value tool, which is new with this new methodology. So let's talk a little bit more about what it means to incorporate a broader range of flood frequencies under Risk Rating 2.0. In addition to commercial catastrophe models, which can model up to 10,000-year events, FEMA is also drawing on the new types of probabilistic flood risk analysis, also known as PFRA. I'm sure if you guys have worked with FEMA and other government agencies, we have a ton of acronyms, so we'll just keep adding to it. So PFRA, or the probabilistic flood risk analysis, helps to create a more robust view of thousands of flood hazards or events to model a broader range of flooding events. So this truly goes way beyond the 1% annual chance flood as depicted on a firm or flood insurance rate map, and provides a more comprehensive view of flood risk. Within the new rating methodologies, excuse me, all buildings are subject to at least one flood peril, and some can be subject to multiple flood perils, which is one of the significant improvements that Risk Rating 2.0 provides. The legacy pricing methodology predominantly takes into consideration two perils, riverine or coastal. But under Risk Rating 2.0, a much broader range of flood perils are taken into consideration. And they include storm surge, tsunami, coastal erosion, inland flood, pluvial, riverine, and Great Lakes. So in the real world, structures can be subject to multiple perils. Risk Rating 2.0 allows FEMA to individually assess 6 different perils and calculate a premium that reflects the risk from each one. Some of these perils are very specific and localized. For example, the Great Lakes peril only applies to areas in the vicinity of those bodies of water, and the coastal erosion only applies to those barrier islands. Now, this is a bit in the weeds, but something to know as you see on this slide. The Risk Rating 2.0 methodology takes into account pluvial or heavy rain and fluvial or riverine flooding perils, but they are combined into a single inland flood peril if a building is located in a non-levied area. But what you should take away from this discussion is that the Risk Rating 2.0 methodology calculates a premium amount for each applicable peril and eventually adds them all up. And that's on top of other fees and surcharges and glide paths to the final premium amount that the policyholder will pay. And all of these calculations happen in the background, but whatever that premium subamount for each peril is, there are multiple variables that contribute to the determination of these premiums, such as the distance to the coast or distance to river, ocean, or as I mentioned before, the Great Lake variable. And so what I just described is a huge shift and a benefit of Risk Rating 2.0, because FEMA would have data on which perils drive the most flood risk, which subsequently then drives the premium amount of each building. And we have also learned from a recent actuarial analysis that one explanatory factor for increases in premiums under Risk Rating 2.0 is that Risk Rating 1.0, or the legacy system, did not account for certain perils like pluvial flooding or tsunami. Now, this slide here shows another way to think about the rating shift and the changes between the current methodology or the past methodology and the Risk Rating 2.0 methodologies. As you know, the legacy system heavily weights the base flood elevation and flood zones to rate risk. Under Risk Rating 2.0, FEMA is using new data sets, new rating variables, broader flood frequencies, and automated tools to determine an individual property's flood risk. And again, a lot more is happening behind the scenes, and many variables will be determined by the geolocation of a property address. Now, here's where we're going to review what is changing as a result of Risk Rating 2.0. FEMA is working towards leaving as much of the complexity as possible to the computers so that FEMA team members can focus their time and energy instead on helping stakeholders understand their risk. By understanding their risk, policyholders can take appropriate action to mitigate against it. FEMA is reducing complexity in the program by simplifying premium discount rules and the quote process. Under Risk Rating 2.0, FEMA will simplify the underwriting rules and application of premium discounts. The quote process will also be simplified. Under the current rating approach or legacy rating approach, insurers or write your owns, WIOs, and the NFIP Direct use in-house rating engines that apply the business rules found in the flood insurance manual. Under Risk Rating 2.0, again, the rating tables go away. They'll be replaced by the rating engine. And so under this new approach, insurers will continue to use their own point of sale systems, but they will connect to a FEMA maintained risk rating engine to get a rate quote through a simpler process and with fewer questions to answer. Under Risk Rating 2.0, industry will continue to ask the questions, but when they need to retrieve a quote, they need to ping FEMA's rating system. Once all the inputs have been compiled, FEMA's rating engine will generate the premium and send it back to the insurer. Industry will then issue the policy and FEMA will receive a report of the resulting transaction. You also may have already heard that Risk Rating 2.0 is eliminating the elevation certificate requirement for rating, and this is true. Another way that we're simplifying the program is that elevation certificates will no longer be required to purchase coverage under the NFIP. And this removes a considerable financial burden on policyholders to obtain an elevation certificate, which can actually cost as high as $3,000 in the mainland US and much more in remote locations such as Alaska or Hawaii. FEMA is increasing its investment in mitigation by expanding the community rating system discounts. Policyholders in CRS communities will receive the same discount regardless of their property's location inside or outside of the SFHA. Discount percentages will no longer be based on the zone. Discounts that apply inside the special flood hazard area today, ranging from 5% or a class 9 to 45% or a class 1, will now apply community-wide. And for you to note, FEMA is excluding properties with known violations of minimum floodplain management standards from obtaining CRS discounts. So we're excluding those properties that have known violations. They should not be receiving those discounts. Now, just back up a section about the elevation certificates that I mentioned earlier. Just want to be clear that this is for insurance purposes. Elevation certificates still may be used for those floodplain management responsibilities. So keep that in mind. All right, let's talk a little bit more about what's changing. We're assessing and reflecting more information by leveraging more information on flood hazards and new ways of incorporating factors like levies into an insurance rate. On levies specifically, FEMA leverages several different sources of data and models, but the National Levy Database provides the key data to determine flood risk that exists behind those levies. The database provides information on what areas within the country are protected by levies and the level of protection that a levy provides. What is of particular interest is to know the frequency of overtopping of the levy and the probability of failure prior to an overtopping. So FEMA worked with the U.S. Army Corps of Engineers to fill in additional information for core and non-core levies as much as possible, including for levies that are not included in the National Levy Database. This process helped to fill in additional information for the vast majority of structures within the entire country that FEMA insures and that are located behind levees. And by going through this exercise with the Army Corps of Engineers, FEMA now knows a lot more about levees beyond their accreditation status. Now, accreditation status is also taken into consideration for risk rating. Just didn't want to leave that out. The legacy pricing methodology doesn't consider differences in risk reduction impacts of levies, such as building to the 500-year or 1,000-year event instead of the 100-year event, building levies that merely meet minimum standards. They're all treated exactly the same under the legacy system. But under Risk Rating 2.0, FEMA is reflecting these differences to account for levies that are reducing flood risk. And in some instances, there are levies that are unaccredited, but they still provide some meaningful level of protection. And that will also be taken into consideration. Prior claims. Under Risk Rating 2.0, FEMA will use the number of NFIP claims paid on a building over the last 20 years as a measure of its riskiness. This variable will not kick in until after a claim has been filed on a policy already under Risk Rating 2.0. Also, FEMA will forgive the first claim, so it won't take claims history into account until the number of claims reaches 2 or more under the new system. Replacement cost value. For the vast majority of policies under Risk Rating 1.0 or the legacy system, replacement cost value is not accounted for. But under Risk Rating 2.0, replacement cost value is an integral input into the underlying rate calculations and will be factored in for all policies in the NFIP book of business. FEMA will use the replacement cost value or the cost to rebuild a building as a variable to determine a premium. The cost to rebuild does not include land value, which is important to note. And this aligns with insurance industry standard practices. Some other changes. FEMA is phasing out the preferred risk policy, grandfathering, and submit for rates, but don't panic. We have a plan for those too. FEMA is phasing out 4 policy types or rating methods: the preferred risk policy or PRP, grandfathering, submit for rates, and the lesser known mortgage portfolio program. These policy types or methods are not required by statute, which is important. On this point, remember, the new pricing methodology assesses flood risk and prices that risk for each specific building. As a result, the price of insurance better signals the flood risk that the building faces. Since preferred risk policies are sold at an undifferentiated price that does not account for unique flood risk, essentially one price fits all. The preferred risk policy is not compatible with the graduated view of flood risk. As discussed before, with Risk Rating 2.0, FEMA is moving from that deterministic view of flood risk to a probabilistic or graduated one, which is more aligned with the industry practice. This also eliminates pricing cliffs, which exist within the legacy program. Also, our analysis finds that preferred risk policies are not paying enough to cover their actual risk. Some of you may be familiar with the flooding that took place in Texas during Harvey. There was a significant percentage of homes outside of the special flood hazard area that received significant flooding. And that happens throughout the nation. So the preferred risk policy comprises around half of the single family home policies in the NFIP. And that's around 1.7 million out of 3.4 million policies. So eliminating the preferred risk policy is absolutely a significant part of this paradigm shift and moving away from business as usual. Now, however, given the need for the financial solvency and stability of the NFIP, former preferred risk policies, particularly those that are actually much riskier, need to pay more for their risk. And with the phase out of the preferred risk policy, FEMA is also eliminating preset combinations of coverage and deductible limits. Preferred risk policies will also be subject to that 18% premium caps under Risk Rating 2.0. So the upward rate increase trend that preferred risk policies are already experiencing under the legacy system will continue under the new rating structure for those policies that Risk Rating 2.0 shows to be underpriced. Now, the last day to purchase a preferred risk policy was August 31st, and that's due to that 30-day waiting period in most cases. So you can't purchase one of those anymore. While there will be no new grandfathered properties under risk rating 2.0, those existing policies that benefit from grandfathering, either by zone or base flood elevation, well, they'll be able to move to their risk rating 2.0 full risk premium, either immediately if their premium is going down, or gradually, which is subject to those annual increases of no more than 18%. And thanks to the new individualized rating and pricing approach, there's also no longer a need for submit for rates. The FEMA risk rating engine can generate a premium quote for any policy. And lastly, the mortgage portfolio protection program that I mentioned earlier, to help simplify the program, it was decided to eliminate the mortgage portfolio protection program, or MPPP, since very few policies actually participate in this program. And it was only around 100. So lenders have other means at their disposal to force place insurance. So now we'll go into what is not changing under risk rating 2.0. Everybody has this question: premium increases. As mentioned before, existing statutory limits on federal flood insurance rate increases require that most rates not increase by more than 18% per year. That has not changed. Also, using flood insurance rate maps for regulatory compliance or floodplain management, FEMA regulatory flood hazard data as displayed on those flood insurance rate maps, or FIRMs as we call them, will still be necessary and essential for communities, as it will continue to inform the floodplain management building requirements. Also, those land use decisions and the mandatory purchase requirement. The appeals process for the flood insurance rate maps through the letter of map change process, or LOMAC process, will also remain the same. However, a zone or base flood elevation change to a FIRM will not immediately change an insurance rate, as these are no longer directly used as a rating variable. A zone or base flood elevation change, however, will continue to impact mandatory purchase and floodplain management considerations. Now, in some limited cases under risk rating 2.0, the flood zone would need to be considered for those AR and A99 zones, and that's due to statutory requirements. And under risk rating 2.0, if a building is being mapped into the special flood hazard area, that building may be eligible for a newly mapped discount. Attaining a newly mapped status, however, does not change the actual flood risk facing that building. And so neither will its full risk premium change, at least not right away. However, the newly mapped discount is in statute, and so eligible policyholders are entitled to it. We spoke earlier about elevation certificates, and those will continue to be used for floodplain management compliance purposes. So while elevation certificates will continue to be used as a tool within the NFIP, the requirement to rate post-FIRM buildings within the special flood hazard area with an elevation certificate will go away under risk rating 2.0. Essentially, elevation certificates will be optional for rating. So, and we'll go into that a little more later on. FEMA is maintaining certain program features to ease the transition to risk rating 2.0. We're doing that by offering premium discounts to eligible policyholders. So we'll continue to offer certain premium discounts provided for by law, including pre-FIRM rates, newly mapped, rated, and other. Other refers to those buildings in zones AR and A99 and communities in the emergency program until they join the regular program. Allowing the transfer of policy discounts to new homeowners. So policyholders will still be able to transfer their discount to a new owner when their property changes ownership. And just like we've done in the past, we stress that it's not wise to let your policy lapse. If you let your policy lapse, you will be brought in at the full risk rate, especially when you're selling your home if you don't transfer that over. And that may be something that prevents you from selling your home because the new homeowner may not be able to afford that full risk rate. Offering premium discounts for community rating system participation. So I mentioned this earlier. So those discounts to policyholders and communities who participate in CRS, they will continue. And then also maintaining group flood insurance policies. There'll be no changes to the GFIP or group flood insurance policies under the new pricing methodology. Under risk rating 2.0, underwriting forms will not change in the way they are used. They are, however, being updated for risk rating 2.0. Underwriting forms refer to the application, general change endorsement, and cancellation forms. The dwelling, general property, and residential condominium building association policy, or RCBAP forms, will stay in place. Yes, it's another acronym. There are a couple of minor changes in some of the forms effective October 1st, 2021. But this is not because of risk rating 2.0, but rather some bundle one regulatory changes. Again, to emphasize what is not changing with risk rating 2.0. Mandatory purchase, floodplain management, those statutory caps, coverages for building contents and increased cost compliance, and that ability to assign a policy to a new building owner, that transferability. And so the path forward is to facilitate the change to the new pricing plan in a phased approach. Now, although COVID-19 has not directly affected our work with regards to the development of this new methodology, we're very conscious of the far-reaching impacts that this pandemic has had on the nation and existing policyholders. So for phase one, which is currently in effect, any new policies that began on October 1st, 2021 were issued using risk rating 2.0 pricing methodology. Also which began October 1st through March 31st of 2022, those existing policyholders that renewed during this timeframe, well, they'll be able to take advantage of any immediate decreases in their premiums if the new pricing methodology shows a decrease. So you can advise those existing policy owners who are due to renew to contact their agent and get a quote under risk rating 2.0. And if that quote is beneficial to them, they can start receiving those savings now instead of waiting till April of next year. In phase two, which is beginning April 1st of 2022, renewals of the remaining existed flood insurance policies will take place under the new pricing methodology. So it's important to note that between October 1st, 2021 and March 31st, 2022, again, current policies up for renewal are expected to renew as risk rating 1.0 policies or legacy policies, unless risk rating 2.0 gives them a better rate. And in order to determine that, insurers have to compare what they would get under both rating methodologies and renew with the lower premiums. And so, as you know, risk rating 2.0 is live. And as of the time I did this PowerPoint presentation, as a nation, we've actually generated over 3.5 million quote transactions, and we've sold over 10,000 policies under risk rating 2.0. And actually, last week, we had our first opt-in policy. So that was an existing policy holder who contacted their agent, saw that they were going to get a decrease or savings, and they took advantage of that. So the system is working. So you might be thinking, how many policies are going up and how many are going down? When we did the national analysis that was completed several months ago, it showed that over 1 million policyholders will see decreases under risk rating 2.0, and this includes over 600,000 single-family homes. And I'll actually paste into the chat, or maybe Dewana, if you have access to it. If you go to our website, there are some state profiles there, and you can download the profile for Florida, which shows the projected increases and decreases by percentage for the state. And then also there are some Excel spreadsheets there that you can download that show by county and by zip code what the increases and decreases will look like. And some of our partners and others that have taken this training have downloaded that and submitted it to their GIS team and had them map it out for their constituents. So that's available on our website, and we'll paste that in the chat. So what about the most expensive flood insurance policies? The policyholders paying the very highest premiums today will actually see a significant and immediate decrease when they transition to risk rating 2.0. At the extreme end of the current or legacy state, 3,000 single-family policyholders pay premiums above $12,000, all the way up to $45,000 per year. And it may surprise you, as it did me, to learn that these policies are located across the nation, not just along the coast. So again, under the legacy pricing methodology, premiums could continue to increase indefinitely. The new plan has an upper bound that limits costs on the highest end of the spectrum. So this means that no single-family home policy transitioning to the new methodology will see a premium of more than $12,125 at the time they transition to risk rating 2.0. Here's that link that I spoke about earlier. We'll also put it in the chat. This is where you can find the profiles of each state, and it estimates the changes of current policies on the risk rating 2.0. So it shows the monthly premium change. And the reason why we did it monthly was because that, through our research, that was the bottom line for those policyholders. What's it going to cost me monthly? And so you can check that out online. So let's review the objectives of risk rating 2.0 and how risk rating 2.0 is seeking to transform the NFIP for the better. And I'm sorry if I'm repeating myself, but these are points we really want to drive home. We specifically focus on the strategic goal and objectives of FEMA's strategic goals to close the insurance gap, strengthen the NFIP, grow policies, and lead to a more prepared and resilient nation. Under the legacy system, flood insurance is more difficult to sell, and current rates do not necessarily reflect and communicate the full range of flood risk for individual properties. Risk rating 2.0 seeks to change the current state of the NFIP by leveraging industry and actuarial best practices to set rates that are fairer. Our new rating methodology has revealed inequities, and as a federally mandated program following Congress's direction, we can't turn a blind eye to our policyholders who may have been unjustly subsidizing other properties. That inequity is, again, policyholders with lower value homes paying more than they should, and policyholders with higher value homes paying less than they should. It's important for the program to correct the situation. In fact, risk rating 2.0 eliminates this inequity. Another way that risk rating 2.0 is a shift from the legacy system is that it allows FEMA to create an insurance product that looks a lot more like one that most insurance agents are familiar with. Under the legacy system, writing and selling a meaningful amount of flood insurance requires specialized skill and knowledge that doesn't have much to do with insurance. The NFIP rules for selling flood insurance have become so complex and very different from what most agents are used to that very few actual agents engage with the NFIP insurance product. Ultimately, changes to the rating methodology can help streamline and reduce the current level of complexity involved in rating a policy and generating a quote. The hope is that with a simpler process, agents can better explain flood insurance and the impact of specific mitigation actions on premiums during the quote process to improve their customers' experience and sell more policies. By simplifying the process, the goal is to better help close the insurance gap and reduce disaster suffering. So I just want to be sure that no one confuses the risk rating 2.0 equity in action with FEMA's proposal for an affordability framework for the NFIP. Those are two separate initiatives. And a little bit about that, FEMA submitted an affordability report to Congress in 2018 and is committed to working with Congress as they consider solutions and proposals to address the significant flood insurance affordability issues faced by many individuals and communities across the nation. So that's ongoing. And that's the end of my presentation, but if you're interested in more information, you can visit the risk rating website. Also, if you have any questions on risk rating 2.0, you can send them to that mailbox shown there. Also, Dewana and myself are available at the regional level. And so with that, I'll open it up for questions.
Hey, Chris, thank you very much. That you've taken a very complicated program and kind of broken it down to the pieces that I think our members are going to need to understand. And I'm glad we're recording this because I'm going to probably have to watch it 2 or 3 more times to fully engage all of the pieces. But I wanted to ask you a couple of questions if I could, and just thinking about our members who are counties, county commissioners, and some of the staff. So under the legacy program, you mentioned that there were basically, 2 primary or 3 primary, components. There's the flood maps. It's 1% flood chance, the 100-year that we always, hear mentioned on the Weather Channel during a big event, and then base flood elevation. And with risk rating 2.0, you've got, again, the FEMA data, but then you bring in all these other modules and different types of flood frequencies and different ways that a property can flood. So my question is, our communities really understand the process that's always been in place, which is they get in line, they hear they're going to get their flood maps updated. There might be some local input. There's preliminary maps that, they have a specific period of time for the community to look at and talk about it, and then there's finally map adoption. Is that going away? And I guess as a follow-up to that question, what can communities expect from just a process standpoint?
So that process is not going away. And actually, Dewana and myself have participated in quite a few of those open house meetings that you generally have, where the general public comes in and gets to map their property and see what the changes may be. So what we've done is we've actually, we make sure that we have an insurance specialist at those meetings for the community officials and then also for the citizens of that jurisdiction to explain the changes of risk rating 2.0 and how that will affect their insurance rating. We can't give them quotes because even FEMA or flood insurance liaisons don't have access to the rating engine, and we're not licensed for that, but we can explain to them those variables that go into it and advise them to see their agent, talk to them. And if they feel that something's not right, there's a way for them to go back and try and make sure that quote is correct. Because we know that the process is new and we're still training agents. So some of it, maybe an error, but that's what we're doing now to address that. As far as the process goes, that mapping process is going to continue as far as I know, but there will be updates coming along the way. Second part of the question?
Yeah, so let's talk about you mentioned the legacy system is kind of a binary structure. You're either in or you're out of the floodplain, okay? And so when you're going to get a federally backed mortgage, the bank sees that and says, okay, you got to go get a policy. So let's say that my property is not in a special flood hazard area as the map. However, the risk rating pulls in all these other factors, and it would appear that I need to get a flood insurance policy. How does those 2 systems work? The one we're used to and this new one.
So my understanding is that that mandatory purchase requirement is not going to change because the firms are still there. So the banks may still use that to determine whether you're going to have mandatory purchase or not. But remember, the banks have that onus on them to protect their investment as well. So if they want to require it outside of there, they can. That's not a federal requirement. It's what the bank requires. So it stays the way it is. But I don't know how the bank's going to react if they see an increased risk outside of that special flood hazard area.
So how do I know whether or not I need a policy on my property? Because is there a search engine? Is there a tool that will allow me? Because, for example, I know right now my primary residence, I'm outside a special flood hazard area. However, is with all of this new modeling, is there a tool that would allow me to go on there and click and say, you know what, you actually have a risk of pluvial flood, flooding? Is that kind of part of the risk rating 2.0?
So the agent will be able to tell the policyholder or the potential policyholder, but it won't be a forced placement or required mandatory unless you're inside the special flood hazard area. So we're used to that already. but the agent should be able to speak to that potential policyholder and tell them what their actual risk is based on the rating engine. Does that make
Do you
sense?
know? Yeah. Do you know what that? Again, I'm going to go back to that legacy program. 1% chance. What will that look like in terms of my property? Will it? I think at one point you had a slide that said 10,000 year event or something. What would it? What is it? What would it look like that says you got 0.001% chance of flooding from this source?
I don't know because I haven't seen that from the rating engine. It's more of something that happens on the agent side. But Dewana, since you're on, do you have any information on that or anything you want to elaborate on?
Hey, Chris. Hi, good afternoon, everybody. I think we're not going to be able to give a specific answer to that at this time. Reason being is because that rating engine is so much in the background on that. That's why they're really harping on making sure everybody knows what variables are included in it. So you could go to your agent and get a quote to see, what that rate will be, and then compare it to what you used to pay. And that's probably going to be the best way that you'd be able to judge or make that decision, if NFIP insurance is good for you or not. But there's not going to be anything specific. Also, you used to be able to look up floodsmart.gov, and they had kind of a pricing tool there. And it would tell you if you were low, medium, or high risk. And that pricing tool may still be there to speak to your risk, but it's not going to give you a dollar amount as to what you would pay to correspond to your risk. So it's really going to be hard for us to give you to kind of pin down an answer for you on that particular question, in all honesty, simply because everything's done through the rating engine in the background. And then we're just making sure that everybody knows, hey, this is how it's done. We want to be really transparent about that part of the house of, how we're getting there. But like Chris said, any time you get a rate and you feel like it's not, hey, this sounds like I went, up $6,000 or whatever the case may be, make sure you go back to that agent. If the agent can't provide you with that explanation, because they have access to FEMA's rating engine, the insurance carrier themselves, your Allstates, Progressives, whatever they are, if the agent can't provide you that explanation, you can work with that actual carrier, because they're the ones that are feeding into the rate engine. Unfortunately, we don't have it with FEMA. So that's pretty much where we are.
That's a fine answer. I wasn't trying to put you guys on the
spot.
And I know you guys didn't create the rating engine, but do you have a sense for why the elevation certificates is not going to be calculated now? And I know some of those elevation certificates, depending on where the property is located, can be expensive. The one I had on my first property wasn't. It was maybe $300, but it ended up saving me a significant amount of flood insurance because I was elevated. At least I had some freeboard. I was about 1.5 feet above the base flood elevation. So why did they get rid of that provision? Because it seems to me that is the best indication that I'm going to be protected from flooding.
So we didn't actually get rid of it. It's not a requirement anymore, because the technology we're using can actually give us a better understanding of each property and the elevation in relation to the lowest or highest adjacent grade. However, we're still accepting those elevation certificates if it's beneficial to the policyholder. If they see that it's going to give them a significant savings, they can submit that, but they don't have to. If they talk to the agent and the agent says, no, the elevation certificate isn't going to help you, they don't have to submit it.
So I got a question from someone I know pretty well and who really understands the NFIP program. And the person is asking, can existing policyholders get quotes now to understand how much their premiums will increase after April 1?
Yes, absolutely. They can contact their agent and they will be able to give them a quote for risk rating 2.0. And again, if it's beneficial to them and they're due to renew, they can take advantage of that savings now, or they can wait till April. And they'll also be given their full actuarial rate that they'll eventually get to if it's going up. And they'll still be on that glide path if it applies.
Okay, thank you. And just as a final question, I want to understand the grandfathering process and the impact of risk rating 2.0. I didn't quite follow all of that. I thought I heard two different things. Can you just reiterate what you stated on that piece?
Sure. And actually, let me see if I can bring up that slide real quick. Dewana, do you mind elaborating on that while I pull up the slide? Just get here.
Not a problem at all. So with the grandfathering, what you'll see is grandfathering is going away. However, there will be a provision for those that have a current property that they may be selling. And if they want to grandfather that current rate path or glide path that they're on to the new homeowner, then they have to make sure that they transfer the existing policy that they have to the new homeowner without lapse prior to closing of that particular policy. The way it's going to work is if you received a policy prior to August 31st, then you, if you were in that low risk areas and you were getting a preferred risk policy, for example, your preferred risk policy would go away. But because you started at such a low glide path, the preferred risk policy may have been $300. The maximum that increase that you'll see is going to be 18% annually until you get to whatever the full risk rate is. Full risk rate is written on your declarations page. So by transferring, say, my old policy or my current policy to the new policy holder, they can take advantage of that lower glide path starting out. But all other forms of grandfathering will go away. Say if it's an existing policyholder that's not purchasing another home, but when their policy renews after April 1st under the new risk rating system, they're also going to be on whatever glide path they're currently on, unless they allow their policy to lapse. So there's a maximum amount that we can charge on the glide path for premium, but it won't be considered grandfathering. It's just that you're starting at whatever glide path you started at under the old system. That's pretty much how it'll work.
Thank you.
I don't know if you found that slide or not. But.
I did, but it didn't say much on the slide, so I figured I'd just let you speak to it.
Oh, okay. Thanks.
Thank you.
Yeah.
Thank you, Dewana. And Chris, thank you, both of you. I think we're just at an hour, and might actually have you guys come back on maybe sometime in the spring as April 1 rolls around. I think we'll formulate some more questions and issues. And like I said before we started this, we'll probably begin hearing from our members in the next couple of months as this stuff begins to roll out and questions come up. So I want to thank both of you for coming on, and look forward to working with both of you again in the future.
Thank you for having us, and we look forward to working with you too. Please let us know how we can help.
Thank you.